The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, this is Christina and welcome to our Scientific Forex Live webinar. I'm happy to see you all here. Before moving on, please tell me if you can hear me. You can type it onto the chat box on the webinar control panel. It's found at the right corner of your screen. Also, if you would like to ask questions, you can also type it into the chat box. We also have a question and answer session during the webinar and also at the end of the webinar. This session is being recorded and will be posted in the members area for you. Also, please remember, our team is standing by if you need any help. If you want to chat personally or need extra help, just let us know. Go to the support section in the members area and call us. Send us an email or use Skype or live chat. We are here for you. On this webinar, we will talk about money management. Probably it will be a boring session in this webinar, but we have to take care of this. It's a very important part of trading, and sometimes this can help us to be on profit. A good money management will help us to survive in this world. So, in trading, it's very good to have a system that gave you good anticipation, but also trading is a game of risk-reward ratio. So one important part of trading is the money management. The money management is actually about this, about the risk-reward ratio we have to consider in our trades. Money management is part of trading. Is the part that helps us to allocate capital for each transaction on the Forex market or in any markets that we are going to invest. Our strategy for money management is to maximize the profit and reduce the loss. When we have a good money management, we will be on profit even if we have not all trades on profit. Any trader have a strategy when intend to be in the market with some trades. Some of traders will make fundamental analysis, some of them just technical analysis, but all have one money management or one strategy to protect against the risk. All those strategies are related to the market we are investing and at the way the market is acting. Why I'm telling you that those strategies are related to the market? Because money management is applied also in types of portfolio in stock market, not only on Forex market. There are some difference between those markets, and actually it's not the subject of this webinar. In this webinar, we will talk about one strategy for money management in Forex market. What we need to know when we make a money management strategy. We need to know the exposure at risk. it is about how much we consider that we can lose into one trade. This is related to the PIP value and to the volatility of the market on the pair we trade. We know very well that each pair of currency have one way of acting in the market. There are pairs where we have bigger volume and they are more nervous or something like this. We have more volatility on those pairs, like the major pairs. I'm talking about euro dollar, pound dollar, yen dollar, Aussie dollar, and Swiss francs. Those pairs are more common, and we have a lot of volumes. Also because the economy of those countries are bigger. Another thing that is about another thing that we need to know when we make the money management strategy is the method we are managing the risk. This is referring to how long we keep the position and if and when we will go into a new position. Actually, in my system, you probably now can see, and you probably made the experiment regarding the signals. For the traders that are going just with the principal trend, they will go on the signal and will go out before the signal that is coming in a contrary trend. But there are a lot of persons that are going also take the both direction of the market. They are taking the trades on the principal trend, and also they are going on retracement. Maybe some of them are overtrading, and they need to pay attention not to take too many positions to have very big exposure in the market. The next point of the money management strategy is the way we can protect our wins or our position. This one and the next point related to how to modify the orders, and in principle how to modify the stop loss into one order, are things that are related with those things are related to what is happening after we are going into one trade. We are going into one trade with the signal. The positions the trades start to be on a profit, and we want to protect this profit. We will look for a way to move the stop loss to have less risk on that trade. We will talk a little bit later about this. And also, it's about to open a new position. When we talk about the exposure at risk, we can consider we can be in the market with just one trade if we take the maximum exposure to that into that trade. But we can split, as most of traders do, we can split that maximum exposure into small quantity of exposure for different trades. Maybe we can trade 2 or 3 pairs, and we have to split that maximum exposure for between all the trades that we have in the market. We have open in the market. So when we open a new position, we have to consider if we have any other trades into the market or we don't have any. So what is let's talk about the exposure to at risk. When we are considering the exposure to risk, we have to take care of types of market we are trading. On this market, on Forex market, we have not so many things to consider because we have just the spread, and for most of the brokers don't have any commission. But when we are trading CFD, because I'm sure that a lot of persons have CFD for commodities or CFD for different type of companies, you also have to consider the commission, and you have to take in consideration not only the spread of one position. We also have to consider the way that market is acting. When we are going into the commodity market, we have one way of investment. We have probably we are making investment in summer. Let's say we are going into one cell in one I don't know, corn or wheat or cocoa or something like this. When we are going into the trade into the summer, we are looking for position that we have to keep for several months. Usually the price is very low before they take out the crops, and the price is growing in the autumn. We have to consider these types of markets. For Forex market, we have to consider if the central banks are making intervention in the market, like we meet in the pairs related with yen or with Swiss franc. This will be the first point that we have to consider, the type of the market. If the market is violent, if we have big variation, if we have big volatility in the market, if we have foreign intervention that can keep the market very quiet, and after some period we have a big variation. And also we have to consider the commission of the brokers. The second point that we have to consider for the exposure at risk is the leverage that brokers offers. This will be related with the value of a pip or of a point. If we have one broker that is offering 5-digit platform, so we have to consider and we have to make the calculation of the value of 1 pip. And related to this, we have to make the calculus related to our equity. And the last thing that we have to consider is, especially in Forex market, is the time frame that we are trading on. Because if we are trading into 5-minute charts, probably we have one variation of 20 up to 30 pips on the 50 minutes time frame. But if we are trading into 4-hour chart or 1-hour chart, the variation of the pairs will be something between 100 up to 200, 300 pips. So when we have one target to 30 pips, we can make a stop loss at 10 pips, and according to the value of the pip that we have on from the broker, we can consider the risk that will be at 10 pips. Let's say for the euro-dollar, for one lot, we have one variation of $10. So for 10 pips, we will have one variation of $100. So we can see if we can afford to lose $100 into one trade to put the stop loss. But if we have, if we are trading on 4-hour charts, when the variation is 300 pips, we can consider one stop loss at, let's say, 50 pips, or how everyone is recommended, risk-reward ratio 1 to 3, 100 pips. In this case, for one lot, the stop loss will be around $1,000. So those things we have to consider related to the time frame we are trading. Why we talk about the exposure to risk and about all those things? Because the common goal of traders is to achieve 1 million profit from trades in their lifetime. Actually, it's when you start to handle one system and you can see that you are into the profit each month, you establish one target. And most of the systems that are in the market, can you offer this chance that to become millionaire by trading? This is not something that is happening with common business. So I will talk with you about if this is something real or not. So let's suppose that we are starting with one capital of $10,000, and we make profit every month 50%. That can be something something easy to do when you are doing trading based in daily basis, when you are taking when you are going on 4-hour charts and you are taking the trades into direction of the trend, and also you are taking the reverse. you can achieve this 50% per month, not working very hard and not working with too many pairs. Maybe 2 or 3 pairs will be enough to achieve this kind of profit. So, when we have this capital and we adjust our risk and we have a good money management, we can, if we are making 50% of the capital each month, we will have this type of growth of the capital. So in the first month, after the first month, we make 50% profit, we will have 50,000 on profit. On the next month, our capital will be 15,000 and 50% will be 7,500. So our capital will be 22,500. After the 12, in the 12th month, we will have in the beginning 820,000 and 50% will be 410,000. So we can achieve 1,230,000. So we cross over that limit that any trader is proposing into one lifetime. I think that this can be done, but you have to deal very good with the system. You have to learn the system very well. You have to take care of money management and to take some time to look over the money management and to make in a proper way the calculation, and also to consider also the problems related with going out from a losing position. Actually, even if we don't have 50% profit each month, let's say we don't have too much time to trade and we don't go in all the trades that are in the market, we can look for a profit of 10%. This is something very easy to do and with very small risk to make this type of profits. It means that we have to be in 4-hour chart, maybe for, I don't know exactly, maybe 10 or 15 trades all month. So it will be enough to have this type of profit. And after 10 months, when we add to our capital each month 10%, we will have in first month 11,000, in the second 12,100, the third 13,300. At the end of the year, we can have $32,589. So we, even with 10% profit per month, at the end with one capital of, we can consider that at the end of the year we tripled our capital. We have 3 times the initial capital. So this can be a good motivation to be in trading. And also you have to consider that there are not so many business that can offer us to have at the end of the year 3 times the capital that we are investing. But we have to learn very well the system. We have to learn very well one system. We have to make exercise, and we have to take care of money management and all those things. Also, you have to consider the own personality. And of course, if you are dealing not only in the Forex, you have to consider the structure of portfolio. The evolution of the market or the level of knowledge. Maybe there are traders that don't want to go into position when we have statements from politicians, when we have the releases from statistical agency or so, because they don't have too many ideas about fundamental analysis of the market. It is okay. You will not make 100 profit per month, but you can make 50, 40, even 10% will be, or if you are making 10% in every month, it will be a good business for you. The exposure is also related to the risk exposure is also related to the margin. And we will talk now about the margin. As a rule for all traders is to have exposure less than 30%. This means that margin for all position to be maximum 30%. So when I'm talking about the exposure, I'm talking about the margin. And margin can be thought as one guarantee required to maintain one open position. This is not a fee. You will take back the money from that guarantee when you are closing the position. This is not a cost for the transaction. The cost for the transaction is the spread for the most brokers. And also I meet brokers like Saxo that have one commission, one fixed commission for each position, different than the spread. The margin is just the guarantee to maintain open the position. When you are opening different position, according to the leverage, you will put one guarantee to the broker to keep open the position. And when you are closing the position, that amount of money will be returned to your account, and the deal with your broker will be closed. What is the margin, and what is the relation with the leverage that we have into the platform, into the brokers that we have contract with. When we have margin 100%, when our guarantee for one trade is 100%, we can tell that the leverage is 1-to-1. This can be happened on the stock market when we are buying directly some shares, or when we are going for a contract for difference for different types of shares. We can have margin of 20%. This means one leverage 1-to-5. We can meet this type of guarantee for some types of CFDs for commodities like wheat, corn, cocoa. We can have one margin 5%, 1-to-20, when we are trading oil or gold or silver. But again, this is related to broker that you choose, and you can find in the contract with them the exactly margin, the exactly guarantee you have to put for the investment that you are making, for the trades that you are doing through that platform. For the Forex market, we have those types of leverage: 1-to-100, 1-to-500, 1-to-100, 1-to-200, 1-to-400, or 1-to-500. And also is depending if they are making calculus for the leverage for points. If you have a 5-digit platform like this one that I am using for webinars from Varengold, or if you have 4-digit platform and the leverage is related to the value of the pips. So in Forex market, for retails, we have for most of the brokers, we have 1%, 1-to-100 leverage for real accounts. It's a very safe way to be in Forex. And by the way, the banks have leverage 1-to-30, so they have to put a biggest guarantee to be into one trade. So this is why they are not going every day into trades. They are not opening position into smaller time frames. They are opening position for minimum 4-hour chart, but most of them are going for daily time frames or weekly, depending of the type of the bank. If it is one investment bank, will be more aggressive. It will be one bank that is taking care just for the risk of deposits that they have. They will go into bigger time frames. Why is important this margin? Actually, in every business, we are calculating the yield of the investment. The yield is the ratio between the profit we are making and the money we are investing. So when we have, let's say, margin 1%, we will have a biggest amount to invest. We have a biggest amount to keep into as guarantee to make one investment. If we have a bigger leverage, like 1 to 200, the guarantee will be smaller. We have to put just 0.5% from the amount needed for one position. So if for the normal business we have one leverage 1 to 100, if we are going to buy shares or so, if we have to put all the money on the table, for Forex business we have to put just a part of the money, and we have this leverage that is offered by the brokers. So our yield of investment will be higher. The profit related to the money that we have to invest will be bigger. Okay. Let's talk about some methods to manage the risk. For this, we have to answer to a few questions. First one is, what is the maximum exposure we accept? And another one is, what is the maximum loss we can take? What I am recommending for all of you is to take the maximum exposure at 10%, especially if you are going into 4-hour chart where you have more accuracy for the system. It means that the margin that you have when you are opening the position, the maximum margin that you put as guarantee into for those positions is have to be 10%. In this case, you will have about 19% to have variation of the pairs. It will be not so big. You will not have big position, and you will feel more comfortable without too many risks. When I'm talking about the maximum loss we can take, I'm talking about the maximum drawdown. So when you are establishing the stop loss, if you are going into the risky position, maybe you don't have to put the stop loss more than 5% of your equity. But anyway, the system is not going to... With scientific forex system, you have to calculate just the exposure. You have to calculate the margin of the position that you are going into the trade. And about the stop loss, if you are looking for the levels, for Fibonacci levels and Bollinger Band, you will never be at 5% risk on stop loss. Of course, there are programs that help us to calculate how many lots we can buy and where we place a stop loss. You have Actually, you have one example of this type of calculation in the manual. Okay. I will go to the next topics that I want to talk with you about in related to the money management, and I will talk about when I can open a new position. So actually, when we have a system, we have to look at the signals we have from it. So maybe I am into one position that I am anticipating that I will keep it for a few weeks, 2-3 weeks. But also I want to trade on daily basis in this period, and I want to open a new position. And I'm going to smaller time frames, let's say 30 minutes and 5 minutes time frames, and I'm looking to position that I'm looking for signals that I can find on those time frames. For the first position that I have into 4-hour chart, I made already one, I have already one idea about the stop loss, about the targets. I placed the stop loss and I'm waiting for the target. If the position is already on profit, I can change the stop loss. And in this way, I already reduce all the risk that I have onto that position that I have onto the 4-hour chart. Because if I have this trade on profit and I'm establishing one stop loss that will be on profit, I can go, when I'm going on the daily basis trades on smaller time frames, I can consider all the equity that I have at my disposal, and I will have one calculation regarding those things starting from this point. But if I just open a position into 4-hour and my stop loss is giving me the anticipation that I have a maximum drawdown that I'm expecting at 5%, like we talked before, I have to forget about that capital. I have to consider those trades that I have on daily basis, like I already lost that capital. So I have a smaller equity to take into consideration when I'm making the money management plan. So considering this, we have to look for the signals that we have from the system. We have to establish the new targets according with the system rules. We have to establish the stop loss for the new trades we want to enter. We have to check the signal if the signal is satisfying the rules of risk-reward ratio. For example, 1-to-3. This is the most common thing that is like a mantra that is among between the traders. And we have to calculate the proper volume for the position we open. Why this 1-to-3 is like a mantra for all the traders for money management. Because let's consider that we have 10 trades in a row, and we have 6 trades. So let's consider that we have 10 trades on 5-minute chart. That means that we have a variation of 20 up to 30 pips for euro-dollar, let's say. So in this case, probably we have the stop loss at 10 pips, and we have the target at 30 pips. We will have one risk-reward ratio at 1 to 3. So in that case, we consider that we make 10 trades, and from those 10 trades in a row, we have 6 loss and just 4 wins. Maybe it was a bad day, maybe the market is very nervous, maybe we cannot manage, we don't have proper signals on 5-minute chart like it's happening. So our help will come not from the accuracy of the signals, because on 5-minute chart we don't have too much accuracy. The best accuracy we have on 4-hour time frame. So in this case, on trades based on daily, based on 5 minutes time frame, we have 6 loss with 10 pips, the stop loss to establish at 10 pips each. It will mean for that day 60 pips as loss for all day. If we have in the same day 4 wins between all those 10 with 30 pips as profit each, we will have at the end of the day 120 pips profit. So at the end of the day, just based on money management, we will have 60 pips on profit. 120 minus 60 pips will be 60 pips on profit. So if you are not managing very well the system, you have to manage very well the money management. If you are going for scalping or so, you have to manage very well all the aspects of the money management. So this is a very simple rule, and this is why 1 to 3 rate the risk-reward ratio is a mantra for traders. So let's see what is the difference between two investors. Let's say that they are making some extraordinary profits, and but they are risking, they are making the stop loss. One of the investor, one of the trader will accept only 3% loss. The other one will take just will go for 10% loss, with the hope that the market will come back and will you will be in the profit. So if each investor will have one winning trade and one losing trade, it is one fiction scenario. It's not happening like this every day. But let's suppose that we have this, because this will give us some numbers that will be, the result will be interesting for us, related about what is happening after 10 trades. So the first investor, both investors are starting with 10,000 capital. The profit that are making into one trade will be 50%, and the loss will be for the first investor 10%, and for the second investor that don't want to take too many risks will be 3%. So first investor, after the first trade, let's say that this will be a losing trade, he will lose 10%. On the next trade, he will make 50% profit. I don't know too many trades like this, but let's suppose that is something true. He will make 13,500 at the end when he is closing the winning trade. On the third trade, he will lose 10% from what he have from this 13,500. He will place the stop loss at 10% of the equity. He will lose 1,350. He will have the new, after he is closing, after the stop loss is taking his trade, he will have in the account 11,150. On the next trade, he will be happy again. He will have 50%. And his equity will be $16,725. But as he used to do, the next one will be on a losing trade. And he will put the stop loss at 10% of the equity. He will lose 1,672. So his equity will be 15. Again, one trade, one happy trade, again, one bad trade, again, a happy trade. And then, after 10 trades, he will have in his pocket about 41,000. But what is happening with one investor that is putting the stop loss? He is looking for the accuracy of the signal, and he is risking only 3% from the capital. He is establishing the stop loss at the maximum 3%, not at 5%, as I advised to you. So he will start with the same capital, but the losses will be smaller for each trade. You can see here the first investor is losing 1,000, the second one just 300. The first one is losing 1,350, the second one 436. So at the end of those 10 trades, he will have a bigger amount in his pockets than the first one that was going into risky trades, and have not the passion to wait for the good signal. He is not taking care about risk, and he anyway. The idea is that you have less risk. If you are accepting less risk, maybe you will need to stay more to analyze the market and to be more careful about when you are going into one position. You will take you will have more, you will pay more attention to the signals, to the accuracy of the signals. Okay. So in conclusion, I have to tell you that to look always to use stop loss. You have to protect the profits. And how we protect the profits. In my system, you know that we have the parabolic SAR, that indicator with a lot of dots. That is a very good way to protect our trades when we are start to go into the profit. Because if we are moving the stop loss level when the SAR is moving, we will it will be one moment when we will be on profit, and our capital will be protected. The third thing is to pay attention to risk. The idea in the forex market is not to have I don't know how many percent from the capital each month. As you could see, even if you make just 10% of the capital you are investing in forex, this is something very comfortable to do. You will have, after 1 year, 3 times the capital you put into this business. So if you can do this business without taking too many risks. You can do this business being very comfortable with the trades you placed in the market. And I think that this will be a good business for everyone. It's more than a usual business is giving to us. The next is to cut the loss. What means to cut the loss? It means to put a stop loss. It means to not move it. If you saw that the pair is the market is going against you, you have to let the market to take the stop loss and to look for the next signal and to go to the next trade, to the next position that you will open into the market. And of course, for the person that are going to go onto the trades in small time frames, to look to the risk-reward ratio that is at 1 to 3. Okay, so now I think that we cover all those aspects that are related with money management. For the calculation, you have one example in the manual of Scientific Forex. If you have any other things that you want to talk about money management, just let me know. If you have any questions, again, please. Okay, so I see that you don't have too many questions this time. I think that in this webinar we have some different aspects of trading that will be interesting for you. I have a few questions. If there is an opportunity to get 1 to 400 or 1 to 500, should we take it? Yes, I think that is okay. Just you have to make the money management and to make the calculation. I mean, what is the margin? What is the value of the PIP? And you have to consider that you will have bigger risk with bigger leverage, but it's okay. It's something that the leverage is something very important in this business. There's one question here. At what point do you move your stop loss to break even, and at what levels do you move it up? Okay, let's go to the chart. And let's okay, what is happening with Aussie dollar? On daily we have, sorry, on daily we have one downtrend. Yes, I'll make it in big lines because we will talk about one. Okay, and the last wave, okay, we can consider that movement, or we can consider just the last one. This is on daily. I will adjust the Fibonacci. So this is what is happening with Aussie dollar on daily. On this period, we have one downtrend. The pair is testing the 50 level. Probably it will test 30.2, 41.4. And I will take one example of trade on 4-hour chart. So I know that is the downtrend. I will look for one sell signal, let's say in this area. Yeah. Here I have the signal from crossover SI, the oscillator of moving average the histogram of oscillator of moving average have the bar smaller and smaller, went to the zero level, yes, and after that it went under the water. Here the histogram of MACD also start to have signals smaller and smaller. The bars are smaller and smaller, and actually we have the confirmation of the cell into this point. So in this case, I will go into one trade here on this candle. I will make it into one other color. No, I don't think that is a good idea with that blue color. So here will be the entry, yes? The stop loss will be a little bit after, above the previous Fibonacci level, yes? Several pips here, above the superior Bollinger Band. So somewhere in this area will be a very good point for the stop loss. Okay, in this moment I will try to establish on one target. The first target will be 38.2, the next one 41.4, 50 and 60. If we are going down, 61.8, or one other Fibonacci level. So if we are entering here, the next step will be 38.2 and the second target 41.4. We have 107 and 142 pips. And for the stop loss, we have 84. In this case, we have to adjust the stop loss to be just a few pips above 23.6, above the Bollinger Band, maybe at the last high that the pairs made. We also can put the stop loss here above on this formation that show us that we have the signal. Yes, here you see the shadow of the candle here, and the stop loss is quite 1 or 2 pips above. So in this case we have, in this case we have about 68 pips for the stop loss, and for the first target we have about 100. For the next target we have 139. So we can, we don't have exactly 1 to 3 ratio for this trade. But if we are looking on daily, we can see also that is not a very good trade, because here we have the crossover SI, but here the signals from MACD is very weak. So we can make our choice related to this trade, if it is a good one or if it is not a good one for us. If we was into that trade that was here on that signal, also with the confirmation of MACD, good trade, we had the we have the entry here, and the stop loss over the pair, the high, and over that Bollinger Band. So here we have the entry. And here the stop loss. So in this situation, we have 36 pips for stop loss and the target at 38.2, 222. We already have one other type of risk-reward ratio. So this can be one trade. This can be one trade, maybe not too much, a little bit smaller. Here will be the target at in this area between 38.2, 41.4. And here is the second one that is not so good. Maybe some of you will be into this trade. Maybe some of you will not be into this trade. This is all the time depending. This is depending of the type of investor you are. On this moment, I'm not recommending. Somebody is asking me, we can enter to trade now on Aussie dollar? No, I'm not recommending one trade now, because here, even if we have one signal for buy, on daily basis, the signal is not yet confirmed. We have to see if the pair will test this trend line. The pair already tested this area, 38.2, 41.4, but was rejected. We don't have a clear signal for sell. We don't have a clear signal for buy. I'm referring to position open for a longer period. Here just made one signal for sell, so it's not a good moment. When the trade is positive, I have one question here. When the trade is positive, say 50 pips, and I adjust the stop loss, that will be after the stop loss ratio to my favor and trade will be on free trade. Yes, it's a good idea to change the stop loss like it's happening here. We have here the stop loss. We see that here the SAR is changing the direction, so we can move the stop loss once the SAR is going down. On this candle, still we have the same levels for stop loss. But on this candle here, we are already into one positive trade. So it's a good idea to protect our wins into trades, especially if we are into 4 hours. If we are on smaller time frame, have no sense to do this. Okay, thank you for listening me. Wait you in the next webinar. I think that in the next webinar we're gonna have some example of trades. In the last webinar we didn't have enough time for all those examples. I want to go again to some trade examples to be sure that for everyone is clear the system. So have a nice day, and thank you that you joined us. Yes, Rudy, I will do in the next webinar more examples of trade, because the system is the most important thing. You are welcome all. Thank you. And